we're living our money life based on expectations, what we think other people want us to do, or from wounds, or from power. Buying and holding, getting into one sector and staying there, just saying that it's going to go forever, that is gone. Very rarely do people put all of their assets together to understand where their exposures are.
All right, Shannon, listen, there's one thing that you said a lot, and that is money has feelings. I've never heard somebody say that. Not only that, I mean, you're writing a book or have a book called Money Has Feelings.
Yep.
Describe that, because when I think about money and what most people think about money, it's not that it has feelings. It's just, how do I manage it? How do I spend it? How do I do better with money? Not
Yep.
like money has feelings. Like, explain that.
So you're right, Chris. Money doesn't has feelings. It's something that can't feel, but how we feel about money, it's a play on words. To me, after 30 years of managing money, is key to financial success. And I think we have it wrong. We think if we got the right stock, we have the perfect investment, we've got the right bond, we've got the right piece of real estate, we open the right company, then we will be financially successful. You may have a lot of money, but your emotional response and how you handle that money, the feelings, the behavioral finance, the neuroeconomics around that money is more important than the money itself. That's my point.
Oh my gosh, we're gonna have such an awesome conversation. But I'm gonna go right at it. Listen, I've been doing this not as long as you, but 22 years. So we both
Long
have
time.
been in this long enough to see a lot
Yeah.
of things. And here's the thing that I've really noticed, and I've come to grips with this with myself as my wealth has gone up.
Mhm.
Money does not create happiness. And what I've found is the more money you make, the less it impacts your life, the less important it is. And a matter of fact, at a certain point, you stop caring about money and you start flipping over to care about, like, what purpose does this money give me? Like, because, I've met, and I know you have, I've met billionaires, multimillionaires, and I'm talking tens to hundreds of millions. These people have more money than they could spend in their lifetime, but they're miserable.
100%.
Why? We work our whole life to make all this money, to get all this wealth. And like the main goal, oh my God, I can't wait till I'm wealthy. Then they're
Yeah.
wealthy and they're miserable because
Yeah.
purpose. I want to hear your take on this, because this
Purpose.
is one thing that is missed and not too many people talk about this.
Yeah, it's so interesting because when it comes to money, we talk a lot about the hustle, how to get money, how to get there, how to build a business. And I want to start by saying there is a significant amount of people in this world that don't have enough money. They're in such poverty. There is no choice, meaning there is no discretionary money to make choices. The rest of us do have choice. And because of the way we think about our money and handle our money, we may not get to that point where we have the wealth to make the decisions we want to make. But there is a crossover point where we've got enough. And you look at these folks that have millions and billions of dollars, and because of fear and shame and expectations and our memories around money and the things I call it scar tissue, it's kind of stuff we carry with us around money that often prevent us from ultimately enjoying that money. And it is one of those areas where I've sat behind closed doors with people, and I still do, coaching 3 clients today, every single day. And it is a privilege. And I am often with my wealthy clients teaching them how to enjoy their wealth. And if they can't enjoy it, how to give it away, meaning how to spread it around and enjoy giving it away. And it's very counterintuitive. If people looked at what I did every day, they would think, wow, you're helping people get out of debt and buy a stock, buy a bond, and build a portfolio. I spend 99% of my time teaching people how to enjoy, how to think about their money properly, how to reframe old scripts, old bias, heuristics, meaning how we respond habitually to money. That's really where the value of what I do comes in.
Oh, you stinking nailed it. One of the things that I've gotten really familiar with is the act of giving, not just giving, right? Because everybody
Yeah.
says that, but the act of it. And my wife and I have a foundation, and obviously, when we first set the foundation up, it's like most people that have wealth, they set a foundation up because they want the tax deductions. I don't mean to sound bad about it, but like that's your motivating factor. It's like, hey, this is money I got to pay to the government, which I don't want to. I'd rather give this money to causes I believe in. So you set up a private foundation and you start putting money in that. But here's what happened for me, and I've seen this with so many people, is once we started giving, we almost got addicted to it, the purpose of it, and like getting super involved. My wife, for almost full time, this is what she does, is just work with other charities, other foundations to figure out how do we make an impact in the world in these tiny little segments, right? Like education in schools is one of our components. We just donated $1 million for that. And then over on the other side, my wife's super into animals and more specifically kitty cats. So a lot of shelters and supporting shelters so they can keep the doors open and do what they do. But
Yeah.
the reason I'm bringing that up, because the folks that are going to be listening to this, I know every one of you are thinking the same thing, right? The giving is what matters because that lights us up. It's far better than closing a big deal and making a bunch of money. When you give it away, it is the most remarkable thing. But then there's a whole nother component. And this is the most remarkable thing. When you give, like somehow, some way, and I can't explain it, it's a universal law, the money just makes its way back. There's always a reciprocation of it. But I think a lot of people, and as I was climbing up, I never understood this. The reciprocation, I was always like, if you give, you get, right? That's what I used to always say. Well, no. You have to give with purpose. You have to want to give. You don't, if you just give because you think you have to, or it's some fundamental thing like I got to give 5% for my foundation this year. Those are the rules. You're doing it wrong. You're missing the point. But the point is all about be into the give, and then the rest just takes care of itself. Have you seen that with clients and yourself?
Yeah, Chris, this is a big, big topic because I got to tell you, just getting to that giving part for many people is really difficult. And I'll share why. And I think one of my advantages is having these one-on-one conversations day in and day out with real people. And it's over the years, seen people reporting on this and writing books and writing papers, but they never sat with a real human being. And I have sat with thousands of real people. Here's why it's complicated. When you're in your 40s and your 50s and your 60s and you start to make enough money, more money that you need for yourselves, like you and your wife, and it starts to flow through you. I'm with you. I think the greatest purpose in making more money is that flow through. I'm a spiritual person. I believe in a higher power. And I believe that it's actually a gift that it's
Amen.
flowed through us to somebody else, meaning that if I can earn more, it gives me a huge blessing to be able to do what you and your wife are doing, to pass it on, to make a donation to children or to kitties or whatever is in alignment with your purpose. But there is a very real human reaction to giving money when somebody is carrying scar tissue around fear, meaning that, or power. So there's two pieces here. I often run into people that are so fearful, so successful, more money, and I can prove it to them. I know that you do e-money and you do planning in your businesses. I have a master's of science in planning, so I plan with everyone. And I will tell you that I can prove numerically that you have enough. You're not going to run out, but people have a tendency because of fear that to hold on so tight to every last dollar. I also see that people, and they end up dying with more than they ever would have needed. And then the next generation either wastes it or chooses to give it away. And they've lost this blessing of this flow that you just described. But the other thing that I see is I see people associating money with power and the only thing they're worth to their family. So if money to you is the accumulation, I've made it when I have 10 million. I've made it when I have 100 million. I'm the man or the woman at 1 billion. But until I get to those numbers, I know what most people have a number in their head. When they get to that number, they want to hold on to it because that's their self-worth, that's their power. And to me, and you just describe it, they're missing often, that's what I said, either use it for a heck of a great life and start to give it away, start to flow it. Because not only does it come back, and I think there's a misrepresentation, like you give a dollar, you're going to get a dollar. That expectation should be there. But for those of us who have done it, understand the flow isn't always monetary. Sometimes it is life experience. So it may not be you give $1 million, you get $2 million back, which it's crazy how sometimes that actually works. But the satisfaction, the life enjoyment that you receive is multiples greater than what you just gave. But to get to that point, you would be shocked at how hard it is for certain people. And I'm not blaming them. We carry, and I did a TED talk about 3 years ago, TEDx, and I talked about what I have called financial scar tissue, meaning it's basically the stuff we carry with us that sometimes we don't even know that we're carrying. And I have to work with people to get through that, often to get to the point of being able to flow that money through and do donations.
I'm going to give you an example. The other day, I was on the phone with a good friend of mine, but his family's worth in the probably high billions. And, we were just talking about tax strategies and just things. And, he was talking about spending 50 grand to do this course with this online guru who's doing tax strategy. I'm like, why would you do that? Let me just show you everything you should be doing and let's see where you're at. And I showed him just very simple things like, are you paying your children? Do you have a foundation set up? Your jet, are you writing that off? Did you do a 179? And we just went down through all these just super simple things to which he was doing none of them. And then I started going heavily into the foundation because, his family has a foundation. And I said, why don't you have one of these? And he says, well, when you put the money in the foundation, isn't that money gone? Like you can't use it anymore. I'm like, it wasn't your money in the first place. So like, this is the key thing. And we're going to move into like some trusts and things like that in a second, but I want to finish up this foundation thing. The way you have to look at this, especially in the beginning, until you get that feeling, that just desire to give because of the purpose it gives you. But the money you would put into a foundation for people with means, and folks, I know, most of you listening to this, I'm speaking to you, the rest of you, this is the future you are going to get there. But when you look at giving, you can't look at it as a standpoint of, I'm going to put money in the foundation and that money's gone and I can't use it and it's out of me. That's that scarcity mindset you were talking about.
Yeah.
You have to look at it from the standpoint, it wasn't yours from the beginning. It was the IRS's money. No ifs, ands, or buts about it. It was the IRS's money. The IRS, just through the tax code, gave you the ability to not give it to them and to keep it yourself and do good with the money. Your good, your purpose. And heck, they even allow you to invest it any way you want to try to grow it to do more good. This is the only way in the beginning you can rationalize this. Yes, the tax deduction is one thing, but we put money in the foundation now. It's not even for the tax deduction. I know it's there, but that isn't the purpose. The whole idea is I want the IRS to get as little of my money as possible. I don't think they do a good job managing it. It's not that I don't have a problem paying taxes. I just don't think they do a good job managing it. Yeah. I think I can do better. Yeah. That's the whole purpose. And when I said this to him, he kind of just had this kind of just aha moment. And I'm like, really? Sometimes I just think, Shannon, I think sometimes I believe people just know this stuff, but they don't. And it was just like, I never thought about it that way. Yeah, really, we're doing this call because you wanted to know how not to pay taxes. I'm telling you, and you're questioning it.
But it's not just a knowledge thing, and that's what I'm trying to say to you is because of what I've done, sitting with so many people, I've realized it's not just. I'm sorry, you can Google all this stuff. Like you can get online and Google all of this and you can get the answers to everything you and I are talking about, but people still don't do it. So there are so many cool tools to get started, and they don't do it because of the emotional side, things that they're carrying with them, their reactions to money, expectations and fears and heuristics and bias and all this stuff that we carry. And so having a coach working with somebody like yourself or somebody like myself to get through this is key, because even for those clients that aren't billionaires, aren't millionaires, who really want to start this, I had two professors, and I talk about them in the book, unbelievable human beings where they worked for one of the local universities. I'm not going to give too much information because you could probably figure out who they are. Very, very successful, no children, were in a very specific area of research in their university and want that work to go on after they're done. They make a great living and they're university professors, but they're not billionaires. And so we sat down and I said, well, what do you want to do? And they go, we have to ask for money every single day. We have to beg for money every single day to make sure our research is funded. We want the generation following us not to have to be fundraisers. We want them to be researchers and have the money. I'm like, cool. How much do you want to give? We created a life insurance, a 10-year pay life insurance on a second to die for them that gave millions and millions of dollars to their research after they both die, that they would never, it was pennies for dollars. We bought insurance and leveraged it on their good health over the next 10 years, paid it off so the payments wouldn't even impact their retirement. And they were able to give more money than they would probably ever have had sitting in the bank with this leverage. So there's a lot of ways of doing what you're talking about, and it doesn't have to be your millionaire friend, which is a great place to go. But the common person who's a professor or a university, a teacher can do it, but it's strategy and it's overcoming some of our own stuff.
You just hit a nerve on that one, a good one. I mean, you were talking about a 10-pay life insurance policy, right? A whole life policy. So the other nice thing about that is if you design that 10-pay, or even if you just do a base whole life, even versus a specially designed one, the money that they put in it, they get to use that money while they're living in an emergency. They can buy cars with it. They can become the bank with it. And then, when that event happens, that we're all going to face when we die. I know we don't like to think about that. When that second person dies, the whole vision they had of ending fundraising for future generations fulfills itself. Self completes right there. I mean, what a beautiful thing to do, right? And you didn't even lose, maybe in the first couple of years, you lost a little bit of liquidity, but you didn't even lose access to your money. So you got your money and you got your desired result. I mean, win-win.
Yeah, you got to be careful how you structure it. I mean, I don't want to get into all the details because
No.
you want to, depending on the size of your estate already, you may actually want to move it out of your estate. You want to maybe put it into an islet. But there is a way of retaining control of that cash value and still doing a post-mortem movement of those dollars to charity. So I don't want to get into all the details, but strategy.
Yeah. And it's nice that, our estate tax limits now are still at those elevated higher levels. So we do kind of have the ability to, play this game with lots of different families that aren't above those limits. But let's take this to another one, because you had said something, and I don't know where I heard this, but you were talking about how when people get to a certain level of wealth, whether they've got enough, they stop asking, how do I make more? And they start asking, what's it for? This is a really unique topic. But I want to kind of segue this topic into another thing. I read a lot of books, and I study Warren Buffett probably way too much. And he's such a unique human being. I mean, I think everybody knows Warren Buffett gave almost his entire net worth away. And you can all know, I mean, how much he's worth. He gave it all away to charities. And a lot of people are like, why? And people were trying to rationalize, well, you gave it to the Gates Foundation. The Gates Foundation invested in Berkshire, and Berkshire is owned by Warren. I guess you could play that game. You're just trying to rationalize. It all comes down to that. What's it for? And Warren also is a smart enough guy that studied families like the Vanderbilts, where they didn't properly plan, unlike, the Rockefellers properly planned. Warren, I would say, has a different planning than the Rockefellers, but, made sure that his kids weren't going to inherit this ginormous net worth and then go squander the money or go do things. He gave them just enough to live a good life. And if they wanted to build from that base, they can, but he wasn't going to give them the whole thing. He gave it all away. And I think that really sums up what you were talking about, or what we're talking about here with what's it for? At a certain point, like, you got to ask that question.
I think it's the first question. So I make people really uncomfortable when we first meet. And I'll tell you why. Because people come into my office, either they send me everything in advance, or we do an introductory call, and then I either see them virtually all over the country, or they come in and they come in with all of their stuff. Here are my investments. Here's what I've done. And what they're looking for is for me to look at, I'm like, darn, you've done great. This is da da da. And I push all of the money, all of the investments, regardless of the side, what they have, before I even look at it and say, hey, Chris, your wife, what's important to you about money? I mean, really, what is this all for? Like this, I'm sure you've done a great job. Let me take a look at it. Maybe areas we can improve, but it's just money. Meaning, what is it for? What is the purpose? And I tell several stories in my book about times where I told a young tech professional couple who came in saying, hey, listen, we're in our 30s, we're earning great money, we just bought this spectacular house, and we're really enjoying our life, except for the fact we just really want to travel. Like, we don't have kids yet, we just want to take off, and when we're not working, we want to be all over the world. And it really maximized that right now. I'm like, awesome. Like, where are you going this year? Like, we just bought this house. And I said, oh, so you're, my age, we called that house poor when I was growing up. And I said, so why did you extend yourself? Well, real estate's always the best investment. And I'm like, not if you're not getting to do what you don't want to do. And I said, the further we got into it, you realize that in their culture, there was a cultural bias to the pride of the family. The parents was that they had good jobs, they made great money, and they bought a really amazing house and drove spectacular cars. These two young tech professionals were not living their life. They were living the life their parents expected. Mm-hmm. I coached them into ultimately selling the house, buying an awesome house that was smaller, more within budget. They have been traveling the last 10 years. They have kids now. Now they're just strapping the kids on and taking the kids. They're living exactly in alignment with their life. But so often money, and all levels of money, low levels, high levels, billions of dollars, we're living our money life based on what expectations, what we think other people want us to do, or from wounds, or from power, meaning that if I have this money, you will respect me. Money is, in the end, primal. I mean, we look at Warren Buffett, we look at people of wealth and success, and we study, how do they do it? How do they get there? And in the end, as a society, what we're teaching people is you want to be a person of means. And if you're a person of means, you are to be admired without an examination of your life. I would submit to you, Warren Buffett's life being examined is pretty amazing. He lives exactly where he wants. He's still married to his wife. Like, there's some incredible foundations and roots there, but that's not true of everyone that has high levels of wealth, because they are so attached to the wealth that they haven't built a life based on their own values and desires. And that misalignment, to me, is where the lack of enjoyment, contentment, and money happiness comes from.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
I love it. I've been doing this podcast so long. I know after everybody's listening to that, they're like, wait, she said a book. What book? So the book is called Money Has Feelings. Don't worry. I'll put the link up in the description so that after you're done watching or listening to this, you can grab the book. But let's just keep going on that exact topic. I think let's bring it back down to like a basic level. When we're younger, we're kind of, our family, our advisors, the first fundamental thing they try to teach is budgets. But what I've found is there's very few people that are living by a budget. I mean, if you look at the credit card debt, the car loan debt, all the debt, it shows nobody's living by a budget, because money's so abundant and so easy to get that everybody is just buying what they want, living above their means, and then bitching and complaining about the fact that they're broke or things aren't working out. And it's just it's a weird dynamic. But where did we? Because, if we look, I'm not going to say our parents, I'm 48, so my parents, are 70 now, but how about our grandparents? It was a completely different game back then. And, you know, some people are like, oh, they just made less money. No, actually, they made more if you adjust it for inflation. They actually made more. Back then, the husband could go off to work and the wife could stay home and run the house, and they could live a good life on one salary. But today, that's very difficult. But today, we live in a debt-induced world where nobody seems to follow a budget. People just are off just kind of rogue. I got to pay a check. You know, it's kind of like, you know, if there's checks in the checkbook, there must be money in the bank. But like, how do you handle clients how do you get them off that track? Like, how do you get them course corrected when they're totally going the way that everybody goes? And let me just say one thing, folks. Will Rogers has the most profound quote that sums up everything you're going to hear us talk about here. And he says, the biggest problem in America is not what people don't know. He goes on to say, the biggest problem in America is what people think they know that just ain't so. We, from a young age all the way up, are taught the things, and we think we know what we're supposed to do, but we really don't. So let's jump into this topic.
Well, Chris, I mean, we'll talk United States. We are overweight. We are in too much debt. It's like not wanting to jump on the scale. We don't want to look at what's coming in and what's going out. I don't like the word budgeting, because when you say, hey, if I said, we need to put you on a budget, everyone recoils. Like that stinks. Like nobody wants, it's restrictive. And we have this entrepreneurial spirit in this country, which I love, but saying that you're going to be on a budget is difficult. So back to money being primal. We want to show, whether it's through, you know, Instagram or TikTok, or there is this whole notion that if we get out there, fake it till you make it, show what you got, and we get ourselves away from the fundamentals, and we are I deserve it society, meaning that I didn't earn enough to buy that car, but I deserve it, so I'm gonna go on debt. Or I didn't have a cash reserve, so I need to buy groceries, and now I'm buying them on my credit card because I've overspent beyond my budgets on other things. Budgeting is another really big topic, and why people keep themselves in debt. And there's no way to get somebody out of debt without going at it in a way where understanding what your run rate is, making sure you've got a cash reserve. It's pretty basic and boring. You can't just pay credit card down. We've done a disservice in this country with, if and a lot of entrepreneurs, I know you talk to a lot of entrepreneurs, hey, we take risks and we have years that aren't great. So if you've gotten yourself in a position where you need to get yourself out, you need to go at it, but you can't just take every last dollar towards the debt. You've got to build cash at the same time, which is not intuitive often, because you're like, wait a minute, Shannon, I'm paying 15% over here, or even if I roll it into a great loan, I'm paying 6 or 7% right now over here on the leveraged loan. And I'm only getting T-bill rates right now, 4.115% over here. So the math doesn't make sense. I got to pay off all the debt. Here's the problem. When you're paying debt off, something's going to happen. Car's going to break. You're going to need a new refrigerator. You're going to need a new roof. And then you're back on credit cards, and it's an endless cycle. So breaking the loop is key. If you're starting out, make sure you don't get into that loop. And even if that means you've got to work 2 or 3 jobs, get it done. Get out and build a cash reserve.
Do what it takes.
Do what it takes.
Love that. All right, we're going to transition a little bit here. I want to go into something. And now, folks, I want to be very clear before we get into this. This is not investment advice. We're not giving you any advice here. If you want to book a call, with Shannon, go ahead and do that. But I want to just have an open conversation, because there's some things I just think that have become disconnected with the traditional advisory world, or just investing as a whole. I feel we have been in the longest bull run in history. Mm-hmm. And I can't remember by the numbers, but let's call it 38 years old or younger. They have not felt the impacts of a recession. They don't even know what it feels like. They remember their parents talking about it, but they don't know that. So we literally are almost living in what I like to call an illusionary period of time, where people think that there is no real downside. Little blips, little pullbacks, but no real downside. And I just feel, and I see it and I hear it, I feel like people are literally being led to the edge of a cliff, and they're going to just go right over it pretty soon. And they're not realizing the risks behind that. They think they understand. Oh, I'm in this for the long haul. Oh, it's, buy and hold. I'm just going to put money in the indexes. I'm just going to let it ride. But they don't understand the emotion. I've now been through 2 recessionary periods, so I've learned it the hard way, the wrong way, the way I don't want anyone to learn it. And what I learned is, you might think that being in it for the long haul is what they say. It's just a paper loss, all those things. But when it actually happens and you look at your statement and it's down 20 and 30 and 40%, like in 2008, I don't care what you thought prior. Yeah. There's this instinctual thing, this fight or flight thing that happens. Everybody goes off the rockers and they sell. They can't take it anymore. I'm going to lose it all. And then it's real. But there's also the drawdown effect that a lot of people don't talk about, because a lot of people think, oh, the market went down 30, but it's going to rebound 30 and I'm going to get my money back. No. That isn't how it works. You lose 30, you got to make like 64 or 67% to get back what you had. So all I'm trying to ask, Shannon, is how do you handle these type of real talks with your clients? Because they don't want to hear it.
Big questions. I love it.
It is. They don't want to hear it. They don't want to hear that there's a downside. They don't want to hear that these things will happen. It's not a matter of if.
It's when. It's when. So I'm gonna do 2 things. I'm gonna give you some fundamentals, and I'm gonna tell you a quick story. So here are the fundamentals. First of all, if you think investment success is choosing the right investment, meaning, hey, I got in low on NVIDIA, or I was in on Bitcoin, that is BS. I'm a bit of a cusser. I'm sorry. Like, I'm holding myself.
I'm from New York. Are you kidding me? Okay. I have a license to swear.
Okay. Like, this is BS. It's bullshit. So how you respond to so when I talk to somebody about their risk tolerance and the markets are going well, the answer is heck yeah. Like, I'm in. I'm completely risky. But and I've been in this for 30 years. So I was in it in the 90s. I was in it in 2000. I was in it in 08. Like, I've been there when people have lost 36, 70%. And then I will tell you, there are very few people that can hang on. They create, and I think of it as a roller coaster ride, meaning everyone wants to strap in to roller coaster with you. And it's a heck of a lot of fun going up. But when you're up on the top, and all of a sudden it starts going down so fast that you can't catch that falling roller coaster, people start jumping out and they go splat and they can't get back on the roller coaster and they do permanent damage. And so what happens is our egos say, I want the next hot thing. I want to be sure I'm in the right place. So they make huge mistakes. What I'm going to tell you right now is we're living in an investment time where it's moving faster than it's ever moved. I think it's awesome. I think it's very cool. But buying and holding, getting into one sector and staying there, just saying that it's going to go forever, that is gone. Meaning that if you think about anything, if you think about big tech, like right now I'm hearing all, people saying, oh my gosh, big tech is over its skis and blah, 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 blah. And I think certain sectors of big tech have been over its skis for quite some time, but there are, but there are areas in big tech with AI and robotics and the genome and kind of what's coming next feels like to me like the early 2000s. Mm-hmm. And in the early 2000s, people lost an enormous amount of money by putting ridiculous investments into anything that had a .com after. If it was the late 90s, if it had a .com, man, they would take credit card debt up to $50,000, put it into the .com, because then they'd be millionaires overnight. A lot of those companies went completely out of business. And that is the same thing that's going to happen right now with this AI, the robotics, and the genome. But yet the opportunity for growth, the same type of growth we've had with some of the big tech over the last 15, 20 years, we've had iPhones, since 2007. So some of this taking off, we've really only been on the internet since the early 2000s. So if you really take a look at where the opportunity is, it continues to shift. So understanding where you're investing, how much you're exposed. Meaning, when I meet with somebody, I'm always shocked because people have their investments, their play accounts, they've got a 401k here, they may have another 401k here. Very rarely do people put all of their assets together to understand where their exposures are. The biggest mistakes people made in '08 and early 2000s and all the other times that I mean, honestly, it was March of 2000 when COVID hit. Markets were down. The S&P was down over 35% in 1 month before it went back up in April. And a lot of people jumped out. And so you went down 35, 37. The S&P right now is comprised of just under 30% technology stock. It was 26% last year. So that tells you how large a percentage that is of the S&P right now. And there's a whole lot of people that just believe buy the S&P and hold and you're going to be fine. They don't understand they have the S&P. Then they love technology. So they have their Apple over here. They have their Meta over here. They have their Microsoft. All outstanding companies. But when you put it together and you do an x-ray, now you've 60, 70% overweighted to tech. When that takes a dive, and it goes fast when it does, that's when you get the draw down so fast that people can't stomach it and they jump out at the wrong time. So, it sounds nerdy, but understanding what your exposures are key. And then it's the emotional side.
I agree. And this is more of a personal thing. I'm a huge Ray Dalio fan. I've studied his writings and his books, intently. And one of the things I've watched is with his portfolio, which is public, any one of you can kind of go on and see, their portfolios. He has shifted heavily. I mean, very heavily weighted into treasury bonds. Now, if you remember back when you got your Series 7, you remember that test? That was a mother of a test. But
my daughter's doing it right now.
So it's probably worse now than it was back when we took it. But nonetheless, like most of the Series 7 was all about bonds and the inverse relationships and everything else. But yep, we just spent a bunch of time talking about S&P and different stocks. But most of what we learned, to get that Series 7 stockbroker license was bonds. And right now, I have to believe, and this is Warren too. Warren's sitting on a lot of cash, but when you hear about Warren's cash holdings, it's largely T-bills and treasuries. Like if you look at it, X-rate, I guess is the word we'll use. So here's how I see it. And I think this is just the most unique opportunity I've ever seen. Again, not investment advice. This is just something I'm doing. I'm looking at long-term treasury bonds, and I'm looking at the Fed action that they did the last couple of years, which is raise rates tremendously. And now rates are on the other side. And we've definitely got a confirmation the Fed is tightening and pulling rates down, okay, to kind of soften the blow of the economy dropping. With that, you're going to, and I've already seen it a little bit, but not as much as I would like. You're seeing a price movement of these bonds. Now, when you buy a bond, folks, you're lending money to the government. It's a simple way of thinking. It's like an IOU from the U.S. government or the Treasury saying, we'll pay you back in a certain amount of time. A long dated would be like 20 plus years. So we could say a 30-year Treasury bond, which means the U.S. government would pay you all your money back in 30 years. And during that period of time, they're going to pay you interest on that money, a yield. But what people don't really focus on anymore is the price movement. Because rates went up, the price of bonds came crashing down. Hence, you saw Silicon Valley Bank and all those banks, go insolvent. It was largely because they were holding so many bonds that when this action happened, the price of their bonds fell out of the sky, and all of a sudden people did a run on the bank and they didn't have the capital and they were losing. But I think the other side is here, and I think that you're going to see a massive increase in the price of these long-term bonds. What is your take on treasury bonds? Because it's not something that many advisors are talking about. It's not sexy. It's not like talking about NVIDIA or Apple or all these sexy tech stocks. It's freaking government bonds. Boring. But I seriously think there's a massive upside on this. What is your take?
For me, as a wealth advisor, bonds always play a huge role in what we're doing. And bonds have been, and the reason why bonds are such a large part of the Series 7, they are far more complicated than stocks. They really are. It's the hardest part of the Series 7 for a reason. All the conversations I'm having with my daughter right now are around the bonds and duration and everything else. When we've had an inverted yield curve, meaning that you get a much higher payout on the short end. So the last 3, 4, 5 years, we've had an unbelievable opportunity in treasury bills. Some of that is starting to fade. Right now, I mean, we can still get a great return, but I've been averaging well over 5% in the last 5 years on treasury bills because they were at 5.25, they're at 4.12. I haven't looked this morning, but and if we have the Fed bringing down interest rates next week, the market thinks about 89% chance that that's going to happen next week. Doesn't mean that the market is right, but it looks like they're expecting about a 0.25% reduction again last week, which will bring the treasury bills below 4%. Still a great deal, depending on what your income is. I think that there's, besides the government bonds, there's huge opportunity in municipal bonds. Absolutely. As well as corporate bonds. But the inventory has been extremely thin, meaning that you really, with the midterm and the long term, we are still not going terribly long because we're taking more risk than we need, and we're not getting the returns that we're getting on that short term, the treasury bonds, and that midterm. So we have stayed government. We've stayed a little bit short. We're slowly starting to move as we're seeing opportunities in more that 7 to 10 year level. But it's bonds are fascinating and complicated and a huge opportunity. They have a very important part in portfolios. I think people make a mistake when they don't have bonds in their portfolio, and it gets back to that liquidity that I talked about earlier, meaning that when the shit hits the fan, and it will again, and let me tell you, everybody says that they know when it's going to happen. That's completely BS. If you go back and you look at the people who said, well, I predicted '08. Here, do something funny. Go back and look at the predictions for the 10 years before they predicted '08. Every year, they're Chicken Little. Sky's going to fall, sky's going to fall. And they were right one year, but they missed the other years of a run up. And your point earlier is it's to me, it's not how much we make. We've kind of made competitive returns on the upside for sure. To me, where I serve clients is getting a competitive return on the upside and doing everything I can to minimize the downside, so we're coming off a higher base when it turns around. And
I'm clapping because that is so rare for financial advisors, and it's just so rare. Thank you for saying that. That's what an advisor's job is to do. That is their sole job, if you ask me. Everybody can make money in an up market, but it's protecting your client's downside. That's what they're paying for. That's why advisors get paid, not to try to make more and more and more. A monkey can do that. They've proven it. And now with AI, which is where we're going to kind of bring this thing full circle to the end, with AI, you don't need monkeys anymore to throw darts at stocks. AI is changing the landscape of investments, and it will never be the same ever again. And that's what I want to talk about next. So let me just have you open it up. Like, what is your take on the future of our industry, given that AI is literally making a presence?
I'm thrilled. I think it's huge. And so for somebody who's been doing this as long as I have, with the amount of assets that I manage, it used to be that I would need probably a team of 10 to work on with, because I'm also the portfolio manager. So I'm running the money, I'm working with the clients. And so I needed a big team. I have myself, kind of a junior partner, and 1.5 staff right now. And that is more than enough because of the tools that I have now to do research, to rebalance it. I mean, it is amazing. So you talked about taxes earlier, and your buddy who you were talking to about tax opportunity. Do you know that there's an AI tax program that is awesome? You put your taxes in it, it would have spit out in 6 minutes at the most, maybe 3 minutes, all the advice you just gave him in a summary. Here are the things that you're missing. Same thing for your estate planning, and the same thing's going to happen with your portfolios. So we're going there. A couple things that we have to be careful of is firewalls and exactly who we're trusting. Garbage in, garbage out. You're still going to need people like you and I to help understand the emotional side of it, because even right now, I mean, you can get on at midnight and the markets were down and you get into some negative spiral loop in your bed and get in your 401k and, bail out and everything goes back up the next morning. I mean, we can still crash and burn ourselves because of our emotional reaction. But as a financial advisor, we're going to be faster and better. And the opportunity, to me, I am a complete tech optimist.
I totally agree. And one of the things I'll say to that is, as a company, one thing we're doing is we're completely redoing all of our workflows, implementing agentic AI into every step of it for exactly what you just said. I mean, you're managing a massive book, right? And
Yep.
you're doing it with what most people would say that's a skeleton crew. But you can do that now as long as you have embraced and invested, because it is an investment, invested into the workflows to make sure that AI is aiding you where you need it. Now, I don't think, and a lot of people will differ from this, but I don't think AI should ever replace humans, but it should aid humans, because you can't replace a human relation. You just can't. There's no computer, no robot, at least in my mind, that will ever be able to do that. It just can't happen. That human relationship, those emotions, that feeling, we can communicate with humans, but all the back office stuff that you just mentioned, the rebalancing, AI does it better than we ever could have. All the back office stuff, filling forms out, changing forms, all that, like AI does it all. So you can focus your time on just being with your clients. And I think that is such a game changer. And it's kind of interesting in our industry. We kind of got a little conundrum going on right now because there's so many advisors that are older that are starting to age out and look at okay, I'm looking to, move on. I'm looking to retire. And then there's successors taking over, but there's not enough successors, enough young folks to take over the aging advisors. Yes. So I think the only solution that we have, because you can't just make more young people that want to go into the financial industry. It's bloody freaking hard. I should say it's bloody effing hard because they don't know how to prospect. They have not been taught from when they were a child. I have a 5.5-year-old. My 5.5-year-old won't be good at prospecting. It's not the environment they're brought up in. We were Boy Scout cookies, Girl Scout cookies, all that. We were just brought up to be natural prospectors, but the new generation is not. That's where AI is going to play such a massive piece in this next phase. And it's happening now. I love that you embrace it. I love that you went into your business and how lean you run it because of technology. It's wild.
Yeah. And I have more capacity with that. And I think it's even going to get better. So, no, I'm excited about the next generation of advisors. And it's going to be a big transition. I think this is how it's going to impact a lot of industries. I think there's going to be always a very deep need for the human, for the behavioral side of everything. We used to have rooms full of people calculating stuff because there weren't calculators. So there was a steno room with, women and men calculating calculations. Now we have computers. So many people are frightened of this change. I think it's magnificent. We've had change through the entire history of our country. And I think that we need to embrace it and use it for good.
Oh, wow. I think that's a great place to wrap this. Shannon, how would people find you if they wanted to do a call with you or your team?
So the best place to find me is at shannon-ryan.com. And so I've got all of my information there. And Chris, thank you. What a great conversation this has been today.
Yeah, it has been. It has been an amazing one. So, folks, we're going to put that up in the description along with the link for Money Has Feelings. Grab a copy of that book, book a call with Shannon and her team. And listen, I know we started, at the level where, super high net worth folks and the different problems they have. But even if that doesn't apply to you today, just know it will someday. Thanks for joining us for this episode of the Money School Elite Podcast. We'll see you next time.